Okay, so you want to own a cannabis cultivation company. Rows of humming LED lights, sticky green buds heavy on the branches, a warehouse that smells like money, forklifts loading pallets bound for licensed dispensaries, checks rolling in from a $30 billion industry that used to be a felony a decade ago. That is the picture. That is what the Green Rush sold you. And for 6 years, it looked like the safest bet in modern American business. Here's the problem. You are looking at the one industry in America where you can be legal, profitable on paper, and bankrupt in the same fiscal year. A cannabis cultivation company is not really an agriculture business. It is a regulatory arbitrage business that happens to grow a plant, and the moment the law shifts, the arbitrage dies. Understand that one sentence, and everything about how this industry mints millionaires and buries billionaires starts to make sense. Now, before we get to the money, let's talk about what you are actually buying when you buy a cannabis grow in America today. Because when someone says they own a cultivation company, that phrase means four completely different businesses, depending on which one of them they actually chose to build. The mistake most new operators make is not choosing badly inside a tier. It is choosing the wrong tier before they run a single number. And once that choice is locked in, every other decision after that is downstream of a mistake you already made. So let's separate the four tiers, because the balance sheets, the risks, and the exit stories are not comparable at all. The first tier is outdoor sun-grown. Think Emerald Triangle in Northern California, Southern Oregon, patches of Colorado, and the newer license fields in Missouri. The plants live under the actual sun, the lights are free, the water bill is a fraction of indoor, and the electric bill barely registers on the profit and loss. Cost per pound sits somewhere between $100 and $300. It is by far the cheapest cannabis to produce anywhere in the legal market, but you get one harvest a year, maybe two if you push it, and your entire annual revenue depends on whether the rain shows up in the wrong week. You are not running a business. You are running a farm that answers to weather, wildfire smoke, and a wholesale market that treats you like a commodity. The second tier is greenhouse hybrid. Glass or polycarbonate roof, supplemental LED lights, environmental controls layered on top of natural sunlight to squeeze out 2 to 4 cycles a year. Cost per pound climbs to somewhere between $300 and $500, but so does your consistency and your yield per square foot. This is where most serious operators land. It is the compromise tier, the one that pretends to give you indoor quality at outdoor cost and sometimes actually does. The problem is that when the wholesale price crashes, this tier gets crushed from both sides because the buyer expects premium and pays commodity. The third tier is indoor warehouse. Windowless concrete boxes, sealed rooms, LEDs running 12 to 18 hours a day, HVAC systems that never sleep and never forgive. Cost per pound jumps to $500 to $900, sometimes higher if you are paying California commercial electricity rates at 19 cents per kilowatt hour. But this is where the top shelf flower comes from, the branded product that dispensaries put on the eye-level shelf and price at $50 an eighth. An indoor grow is not a farm. It is a data center that happens to have plants in it, and it fails in the same way data centers fail. One HVAC failure in July can kill a full crop worth $600,000 in 3 days. One power outage can trigger a mold event that ends you. The fourth tier is craft cannabis. Small footprint, hand-trimmed, single-strain focus. Sold to a niche audience willing to pay twice retail for something that feels artisan. Cost per pound can hit $1,200 or more, but the sell price hits $3,000, and the branding is the actual product. This tier does not compete with the other three. It competes with wine labels and small batch spirits on a completely different playing field. And here's the trap most people never see. The four tiers do not just have different costs. They have different customers, different competitors, and different failure modes. Buy an outdoor grow, expecting to sell to boutique dispensaries at premium prices, and you spend 3 years discovering nobody wants your flower on their top shelf. Now, here's where the naive mental model starts to break down. All four tiers hold cultivation licenses. All four call themselves grows. Almost nothing else about them is the same. Their electric bills are different by an order of magnitude. Their labor structures are different. Their compliance costs are different. Their exit multiples are different. The people who buy outdoor businesses at commodity valuations get eaten alive when they try to compete with an indoor operator on shelf placement. The people who buy indoor businesses at premium valuations get eaten alive when the wholesale price crashes and their electric bill does not. None of this shows up in the license paperwork because the state does not measure any of this. The state measures one thing: canopy square footage. Canopy square footage is how many square feet of plants you are legally allowed to have flowering at any one time. That is your license cap. It is not revenue, it is not profit, it is a ceiling on production, and every operator you meet will quote it like it means money. It does not. Because a license does not say what business you are actually running. It only says how much of that business you are allowed to run. So which tier makes the most money? None of them, at least not reliably, and not until you understand the second layer of this business. Because tier alone does not tell you if you make money. It tells you the shape of the mountain you are about to climb, not the height. The height depends on costs the license paperwork never mentions, costs that live below the revenue line and quietly determine who survives the next crash. Choose the wrong tier, and every other decision after that is downstream of a mistake you already made. Now, let's talk about what nobody puts in the pitch deck. Because tier picks your ceiling, but 3 hidden cost layers decide whether you ever get near it. These are not costs a first-time operator ignores because they are lazy. They ignore them because the industry itself hides them behind clean per pound math. The pitch deck shows you 60% gross margins. The operator running the same facility across town shows you 8% net margins. Both numbers are true. Both come from the same business. The gap between them is where the whole story of cannabis actually lives. So we are going to walk through the 3 layers that live inside that gap: electricity, labor, and compliance. In that order, because that is the order they kill you. By the time your first pound is ready to sell, you have already spent between $400 and $700 producing it, and that is before we talk about taxes. Read that again. Between $400 and $700 per pound on a product that in some California markets currently sells wholesale for $40. Layer 1 is electricity, and it is bigger than most people can imagine until they see the first bill. Indoor cannabis uses roughly 2,000 kilowatt hours per pound produced. Compare that to a data center. A modern hyperscale data center runs at about 200 watts per square foot. An indoor cannabis grow can run at 2,000, 10 times the electrical intensity of a data center, in the same square footage. And unlike a data center, your product is a living thing that dies without cooling. A 20,000 square foot indoor facility in California, running full canopy, will burn between $80,000 and $150,000 a month on electricity alone. That is before you have paid a single trimmer, before you have written a single check to the state, before you have shipped a single package to a dispensary. In New York, where commercial rates hit 26 cents per kilowatt hour, that same facility can cross $200,000 a month during peak summer cooling. The lights themselves are only part of it. HVAC is roughly 40% of the load. Dehumidification is another chunk. The plants sweat, and every drop of that has to leave the room. Miss the humidity target by 5 points for 3 days, and you get powdery mildew across an entire flower room. That is a 6-figure loss in a week. One indoor grow in Sacramento reported a single July electric bill of $180,000 on a facility that was supposed to break even at 40. Why does electricity break so many grows? Because in this industry, the sun is a competitor you cannot fire, and the sun charges nothing. Outdoor competitors pay nothing for photons. You pay 2,000 kilowatt hours per pound for the same photons, and then you have to convince a buyer your flower is better. Some indoor operators try to solve this with solar. It helps around the edges. It does not solve the winter load, and it does not solve the HVAC problem at night. Others try to solve it with cheaper power markets, moving operations to Oklahoma or Nevada. That works until state politics or local ordinance shifts, and then it stops working. None of this is decoration. Electricity alone can push cost per pound above the wholesale price, and there is nothing operational you can do to fix that. And when a grid operator changes rates, or a utility ends a favorable cannabis-specific tariff, your entire cost structure changes overnight, and there is nothing you can do. Layer 2 is labor, and it looks smaller until you look at the burden. On paper, cultivators, trimmers, and compliance officers earn wages similar to warehouse workers. In practice, cannabis cannot access most federal payroll benefits, cannot access federal banking, cannot claim the small business tax credits that every other industry treats as normal. So burdened labor rate in cannabis runs about 35% higher than in comparable agriculture because you are paying every cost in cash through workarounds or through fees. Trimmers alone can consume 10 to 15% of your total operating budget. Machine trimmers help at scale, but degrade the final product enough to matter. Hand-trimmed flower sells for more, but hand-trimmed flower requires a room full of humans, each processing about 2 to 4 pounds a day at premium wages. Compliance officers are their own line item. Any grow above a certain size needs at least one full-time person doing nothing but metric data entry and audit prep. Security is another. State law in most jurisdictions requires 24/7 armed or unarmed guards on site, plus camera systems, plus 90 days of video retention. That is a headcount and a technology stack most agriculture businesses would consider absurd for a crop, and yet it is the baseline in cannabis. You are not paying farm labor rates. You are paying pharmaceutical facility rates for a product that sells at commodity prices when the market turns. And when the wholesale price crashes, you cannot lay off the guards, you cannot lay off the compliance officer, and you cannot lay off the trimmers fast enough. One California operator laid off half their grow team in early 2023 to survive the crash. The mold events that followed cost more than the salary savings, and the license nearly went with it. Layer 3 is compliance, and it is the one that turns cannabis into a completely different animal from the outside compared to the inside. Every jurisdiction stacks its own requirements. State license fees run $20,000 to $200,000 annually. County adds another layer. City adds another layer. Then you get seed to sale tracking. Every plant tagged, every gram accounted for, every movement logged in a state-operated system called MEDRC or its regional equivalent. Testing labs sit at the gateway. Every batch must pass pesticide, heavy metal, microbial, and potency testing. Cost per batch runs $500 to $1,500, sometimes more. Fail a batch, and you cannot remediate freely. In some states, you destroy the batch. In others, you can reprocess into extract at a fraction of the value. A single labeling change from the state can force a full inventory relabel across every SKU. That is weeks of labor, thousands in materials, and lost shelf time at retailers. And then there are the fees inside the fees. Renewal audits, inspection surcharges, packaging compliance, labeling redesigns every time the state updates a warning statement. In total, compliance costs a well-run operation between 8 and 15% of gross revenue every year before a single dollar of tax hits the books. The paperwork itself is a business. There are compliance software companies charging cannabis operators $5,000 a month just to keep the audit trail clean and current. A tomato farmer does not have any of this. A vineyard does not have any of this. A brewery deals with a fraction of it, and no seed to sale tracking. So the industry looks like agriculture on the outside, and it looks like pharmaceuticals on the inside, and it gets to pay for the worst parts of both. Why does no other agriculture industry have anything like this stack? Because no other agriculture industry is federally illegal while being state legal. The paperwork is the price of that contradiction. None of this is decoration. It is the reason the biggest cost in cannabis is not cannabis. It is the cost of being allowed to sell cannabis at all. And if you have been keeping track, we have not even reached the part of this business that is actually designed to break operators. We have only reached the operating layer. There is a second cost, sitting on top of all three of these, that has almost nothing to do with growing plants and everything to do with a paragraph. A paragraph written in 1982 by a Congress that had never heard of a legal cannabis market. A paragraph that is still there. A paragraph called 280E. Now we get to the part of this business that actually explains everything else. The part where all three cost layers stop being the problem, and one law becomes the problem. Because if you have been running the numbers, you have already noticed something. The operating costs are ugly, but they are not impossible. Plenty of businesses run on 8% net. Restaurants run on 8% net. Grocery stores run on 2%. Cannabis at 8% should be a survivable, even attractive business at scale. Except, cannabis does not get to keep its 8%. Cannabis gets to pay federal income tax on gross profit, not on net profit, on almost everything above cost of goods sold. And that single accounting rule turns an 8% net margin business into a business that owes the government more than it made. That rule is called 280E. Section 280E of the Internal Revenue Code was written in 1982. Congress passed it after a cocaine dealer named Jeffrey Edmondson successfully deducted business expenses on his federal tax return. The court ruled that even illegal businesses could deduct expenses under standard tax law. Congress panicked. It wrote 280E to close the loophole for drug traffickers. The exact language of 280E says no deduction or credit shall be allowed for any business trafficking in a Schedule I or Schedule II controlled substance. Cannabis is Schedule I. Legal state cannabis is still Schedule I federally, which means every state legal cannabis business in the United States falls under 280E, whether they sell to grandmothers with cancer or teenagers with anxiety. Here is what that means in practice. A normal business can deduct rent, marketing, salaries, insurance, utilities, professional fees, depreciation, and dozens of other operating expenses. A cannabis business can deduct only cost of goods sold, meaning the direct costs of producing the product. Everything else is federally non-deductible, even though it is a real dollar out the door. So a cannabis cultivation company with $3 million in revenue, $2 million in cost of goods sold, and $800,000 in operating expenses shows a net income of $200,000. The IRS looks at that same company and sees taxable income of $1 million, because the operating expenses are not deductible under 280E, even though they were spent. Federal tax on $1 million of income at corporate rates is roughly $210,000, and the company only made $200,000 in actual profit. So the company earned $200,000 and owes $210,000. Read that again. It owes more in federal tax than it made in actual net income. That is not a theoretical example. That is the average shape of a licensed cannabis operator in the United States today, in almost every legal state. Effective federal tax rate for a well-run cannabis business under 280E runs between 70 and 90% of net income, sometimes over 100%, which means the federal government can and does take more than the operator earns. And that is before state income tax, before excise tax, before cultivation tax gets added on top. In California, layer on top a 7.25% excise tax at retail, plus cultivation tax per ounce, plus state corporate income tax, plus city tax. Total effective tax burden on a legal California cultivator can exceed 90% of net income in a normal year and over 100% in a crash year. You can be profitable and still owe more in taxes than you made. That is not a bug. That is the business model Congress designed for cocaine dealers, still applied to legal cannabis. 280E is not a tax law. It is a punishment code that Congress wrote in 1982 for smugglers and forgot to fix when half the country legalized weed. That is the actual policy status. Federal law treats you like El Chapo. State law treats you like a farmer. You pay for both, and there is currently no legal way to file yourself out of the contradiction. Now, before we get to how anyone survives 280E, there is a second regulatory trap that most operators do not fully understand until it is too late. Cannabis is federally illegal. That means every state that legalizes it is running its own isolated market. Cannabis grown in California cannot legally leave California. Not to Nevada, not to Oregon, not to New York, not to Massachusetts. Not by truck, not by mail, not by drone, not by any means of transport. The moment a cannabis product crosses a state border, it stops being a state legal product and starts being a federal felony. Full stop. This creates something economists call market islands. Every legal state is an island. Prices, supply, demand, licensing dynamics all exist in isolation from every other state. California produces multiple times more cannabis than California consumes. Historically, much of that surplus flowed illegally to states without legalization, and that pressure release valve kept prices somewhat stable. After 2020, more states legalized and started building their own supply. The illegal export market shrank, and California suddenly had to consume everything it grew inside California. Meanwhile, New York legalized in 2021 and could not import a single legal gram from California. New York had to build supply from scratch, in-state, from zero. So in the same country, in the same year, wholesale cannabis in California sold for $40 a pound, while wholesale cannabis in New York sold for $3,500. Why doesn't California cannabis just ship to New York, where the price is nearly 100 times higher? Because the moment that truck crosses a state line, it stops being cannabis and starts being a federal felony. You could solve every operational problem in California cannabis today by opening a single legal channel to New York, Ohio, Minnesota, and Delaware. That channel does not exist and cannot exist. Not while cannabis remains Schedule I federally. Not while interstate commerce clauses interact with the Controlled Substances Act. Not without a congressional vote that has been promised for a decade and never happened. A ranch loses money to weather. A cannabis grow loses money to a paragraph. The paragraph is 280E, and the border is federal law. Both are written in the same city, by the same body. Neither has been updated for the reality of a $30 billion legal industry, and the operators pay for that lag every single day in every single tax return. So the big idea is this. Cannabis at the ground level looks like an agriculture business. At the finance level, it looks like a subscription business with recurring dispensary orders. At the tax level, it looks like a punishment code from a war that ended 30 years ago. At the logistics level, it looks like a series of isolated islands. You are not running one business. You are running four, stacked on top of each other, each with different rules. And the rules of the top layer eat the profit of the bottom layer. The operators who make money are not the ones with the best plants. They are the ones who understand which layer is currently binding and reposition faster than the others. The operators who die are the ones who thought they were in agriculture. They optimized yield per square foot and were destroyed by a tax rule from 1982. This is the point where the tier you chose in the beginning stops mattering. Because whichever tier you picked, 280E is applied to it the same way, and the interstate cage locks it in the same way. And there is one company that already ran this experiment for you at full scale in front of the entire industry. They spent $2 billion proving that the physics of this business does not care how much you raise. So far, so good. Now let's talk about who has already run this experiment for you and lost $2 billion proving what we just walked through. Because the theory of 280E is one thing, and watching it destroy a $2 billion company in real time is a completely different education. In 2018, one company sat at the top of every cannabis investor pitch deck in North America. They were called the Apple Store of Weed. Their name was MedMen. Their stores looked like Apple stores. Their branding looked like Apple branding. Their founders talked about cannabis retail the way Steve Jobs talked about smartphones. Their valuation touched 2 billion Canadian dollars at peak, roughly 1.6 billion US, before the crash. By 2024, they were essentially worthless. To understand MedMen, we have to first understand the market they were operating in. And the market they were operating in was California between 2016 and 2023. California legalized recreational cannabis in November 2016, effective January 2018. Wholesale flower prices at that moment sat around $2,000 per pound for premium indoor product. The state issued cultivation licenses aggressively. By 2020, licensed canopy in California exceeded projected demand by roughly 3 times. 3 times too much cannabis was being grown, legally. Combine that with the interstate transport ban we just walked through. All that excess supply had nowhere to legally go. It had to be consumed inside California or destroyed. It was not destroyed. It was dumped into the wholesale market at whatever price would move it, and the price started falling. Fast, continuously. For 6 years. By late 2019, wholesale flower had dropped to around $800 per pound. By 2021, it was below $400. By 2022, it was below $200. In summer of 2023, wholesale indoor flower in California traded regularly at $40 per pound. Outdoor flower traded lower, right? Sometimes below $100 per pound, sometimes closer to nothing. $2,000 a pound to $40 a pound in 7 years. That is not a market cycle. That is a controlled demolition. And every gram of that price collapse still had 280E stamped on it. Let that land for a moment. The lower the price got, the deeper federal tax cut into what was left. At $2,000 a pound, an operator could absorb 280E and still survive on brand and scale. At $40 a pound, 280E takes what little margin exists and then some. Roughly 70% of California cultivation licenses issued between 2018 and 2020 are now inactive, expired, surrendered, or in the middle of ownership disputes. The rest are surviving on capital reserves and denial. This is the market MedMen was operating in. Not a growing market, a collapsing one. And they were expanding into it at a rate no financial model could support. Because their story is not just a story of one company. It is the story of what happens when a strategy that works in a bull market meets 280E in a bear one. Cannabis in 2018 looked like the next great American consumer category. Cannabis in 2024 looks like a series of expensive obituaries. MedMen wrote the biggest one. MedMen was founded by 2 entrepreneurs named Adam Bierman and Andrew Maudlin in 2010. Originally as a cannabis management consultancy, it became a vertically integrated cultivator, distributor, and retailer. By 2018, they operated dozens of dispensaries across California, Nevada, New York, Florida, and Illinois. They went public on the Canadian Securities Exchange in a reverse merger. Their pitch was simple. Cannabis is going mainstream. The winner will be whichever company builds the best retail experience first. We are that company. Fund us. Investors funded them. Roughly $500 million over the life of the company. Institutional money, high net worth individuals, family offices chasing the green rush. All of it went in. The retail build-outs cost $1 million per store on average, some closer to $2 million. Premium locations, custom shelving, iPad checkout systems, museum-quality lighting. The founders reportedly used company funds for private jet travel, art collections, and personal expenses that later became the subject of lawsuits by their own board. Meanwhile, 280E was quietly eating them alive. Every marketing dollar, every rent payment, every salary at corporate, every dollar of the retail experience they were selling, all non-deductible. MedMen was booking hundreds of millions in revenue by 2019 and losing hundreds of millions at the same time. The gap was not incompetence. The gap was structural. Then California prices started collapsing. Their cultivation operations, valued at premium multiples during acquisition, became unprofitable at wholesale. Their retail stores had to sell product below cost to compete. Because they could not access federal banking, most of their debt was privately structured at 15 to 20% interest rates. Some tranches ran higher. Interest expense compounded. By 2020, they were laying off staff. By 2021, they were closing stores. By 2022, they were being sued by their own investors. By 2024, they were being delisted. At the end, MedMen's stock traded at fractions of a cent. Their remaining assets were sold for pennies on the dollar. Their founders were replaced. Litigation continued. Roughly $2 billion of enterprise value evaporated. Investors lost most of what they put in. Employees lost jobs. Landlords in some cases lost lease income entirely. MedMen did not die because weed stopped selling. Weed kept selling. Legal cannabis sales in the United States hit $30 billion the year MedMen was being wound down. MedMen died because they built a premium consumer brand inside a regulatory structure that punishes premium consumer brands and rewards low overhead, low expense, low visibility operators. They optimized for the version of cannabis America would have if 280E did not exist. And 280E did exist and does exist, and the version of cannabis they optimized for was never coming. The lesson here is not that MedMen was stupid. Their retail was beautiful. Their branding was best in class. Their operations improved every year they were public. They were wrong about one thing only. They believed the green rush had landed. In reality, the regulatory structure had not landed. And the regulatory structure runs everything. Every operator in this business is running the same experiment with different capital. Some have already crashed, some are in the process of crashing, some will crash next. Which raises the last question we need to answer before you sign your name on a cultivation license. In this landscape, what does it actually take to make money? Now, before we close, let's put two scenarios side by side. Because averages lie in this industry more than in almost any other, and the average operator does not exist, there are essentially two operators in cannabis cultivation today: the one who makes money and the one who does not. And the gap between them is not marginal. The one who makes money represents somewhere between 2 and 3% of licensed cultivators nationally, according to the most recent industry surveys. Almost everyone else is losing. So let's look at both, side by side, with actual numbers, and see what separates the 2% from the other 98. Scenario A. You buy or build a cultivation license in a newer legal state. New York, Ohio, Maryland, Minnesota, Delaware. Somewhere, the supply has not yet caught up to demand. You build a mid-sized indoor facility, 20,000 square feet of canopy, tightly managed for consistency. Your cost per pound comes in around $400 fully burdened. The wholesale market in your state currently pays between $2,500 and $3,500 per pound for premium indoor flower. You sell at $3,000. Gross margin on paper is around 87%. That is real revenue minus real cost of goods before anything else touches the number. Then 280E hits. Federal tax swallows the operating expense deductions you would have gotten in any other industry. Your effective federal rate lands around 75% of net. State tax, excise tax, and local tax layer on top. After everything, you keep somewhere between 12 and 18% of net income as actual take-home cash flow. On a mid-sized operation doing $8 million in revenue, that is roughly $1 to $1.5 million of actual annual profit in your pocket. Return on invested capital sits somewhere between 3 and 5 years, if the market holds. If the state issues aggressive new licenses, that window closes rapidly. And here is the catch that makes this scenario fragile. It is not a business model, it is a race. You are racing to recoup capital before your state becomes California, because every new legal state follows roughly the same arc. Undersupply for 2 to 3 years, balance for 1 year, oversupply forever after. Scenario B. You buy or build a cultivation license in a mature legal state. California, Oregon, Colorado, Washington, Michigan. Somewhere the arc has already run. You build the same 20,000 square foot indoor facility. Your cost per pound is roughly the same, maybe $500 because energy costs are higher. The wholesale market in your state pays between $100 and $300 per pound. If you produce premium flower, you might touch $400 on your best month. Gross margin on paper is negative before you take a single deduction. Every pound you produce costs more to make than the market will pay you to sell it. Then 280E hits. Federal tax applies to gross revenue minus cost of goods sold. Even though you are losing money on operations, the IRS still calculates taxable income differently. In some quarters, you owe federal tax on paper income that you never actually saw. The tax return says you made money. The bank account says you did not. You cannot lay off compliance officers. You cannot skip the state license renewal. You cannot stop paying for electricity because the plants are alive and die in 3 days without it. So you burn capital. Every month you burn capital. If your investors keep funding you, you last 2 to 4 more years. If they do not, you last 6 months. Eventually you surrender the license, sell the equipment at auction, and settle whatever tax debt the IRS is willing to negotiate on. That is the exit for 90% of grows in mature markets. This is not a small subset of the industry. This is the industry. Most cannabis cultivation companies operating in the United States today are living inside scenario B, waiting for something to change. So look back at the picture we started with. Rows of humming LED lights, sticky green buds heavy on the branches, a warehouse that smells like money. All of that is real. But so is 280E. So is the interstate cage. So is the 70% tax that treats you like a smuggler while the state treats you like a farmer. And so is the fact that a market can crash 98% in 7 years, and everything you built for the previous price disappears with it. The operators who survive this industry are not the ones with the best genetics, or the biggest facilities, or the most impressive branding. They are the ones who read the law the earliest. They picked states before those states became saturated. They kept operating expenses obsessively low, because low overhead is the only defense against 280E worth building. They built exit optionality into every capital decision. They assumed the regulation would not change on their timeline and priced accordingly. And most of them still nearly went under. Because in cannabis, the plant is the easy part. The lights are the easy part. The equipment is the easy part. The real business is elsewhere entirely. The people who make money in cannabis are not the ones who grow the best plant. They are the ones who read the law the earliest and know that the law is the plant. Everything else, the lights, the buds, the pallets, the smell of money in the warehouse, is decoration. The paragraph is the business. It always was.